Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
You've probably been told that money is simple. You work, you get paid, you save, and over time your savings grow. That's the story we're taught, that the economy is neutral, that money holds its value, and that your wealth belongs to you. But what if that story isn't just incomplete? What if it's fundamentally misleading? What if the money generations before you earned, saved, and passed down was quietly drained away long before it reached your hands? And what if the same quiet process is still happening right now, every single day, without most people even realizing it? This isn't a story about thieves breaking into vaults or governments raiding bank accounts. It is a story about something far more subtle and far more powerful. The way the modern financial system slowly extracts value from people who don't know the rules. A system that was built over centuries, hidden in economic policies, shaped by war, crisis, and political decisions that seemed reasonable at the time, but came with a price paid by future generations. If you've ever wondered why your grandparents could buy a house on one income, while you struggle with two, why salaries rise slower than living costs, why saving money feels pointless, or why national debt keeps rising no matter who's in power, then you're already seeing pieces of the mystery. You're seeing the symptoms of a long process that started long before you were born. But to understand how money was stolen from generations before you arrived, and how it is still being taken, we need to go back to a time when money wasn't T numbers on a screen, when wealth wasn't based on trust alone, and when entire empires rose and collapsed over the question of what money really is. And the story begins with a metal that changed the world. For most of recorded history, gold and silver weren't just symbols of wealth, they were wealth. They were scarce, physical, limited by nature. A ruler couldn't simply declare millions of new gold coins into existence. To create money, you had to find it, mine it, refine it. But that didn't stop rulers from trying to cheat the system. Imagine a king facing expensive wars, drought, rebellion, or the cost of maintaining an empire too large to afford. He needs money, but he can't magically create gold. Or can he? Instead of creating gold, rulers found a simpler trick: debasement. They melted coins, mixed in cheaper metals, and minted more coins with the same face value. People accepted them at first, but over time, merchants noticed the coins felt lighter. Prices rose as trust fell. And just like that, the earliest form of inflation began. This trick was repeated across civilizations. In ancient Rome, the silver content in the denarius fell from 95% to near zero over the centuries. As the money weakened, the empire weakened with it. Inflation soared. Soldiers demanded payment in real goods, not coins. The economy cracked. But what happened next was even more important. Rulers learned a lesson. The public hated obvious debasement. The effects were too visible, too easy to blame on the people in charge. So, over centuries, the techniques for quietly weakening money became less obvious and far more sophisticated. Fast forward to medieval Europe. Monarchs and early bankers began issuing promissory notes, paper claims representing gold stored in vaults At first, the system worked. People trusted the notes because they could exchange them for metal anytime. But soon, banks realized a loophole that changed history. Not everyone withdraws their gold at once. So why not issue more notes than the gold they actually had? This was the birth of fractional reserve banking, a system where banks kept only a fraction of actual money and lent out the rest, multiplying the supply of paper claims far beyond the physical gold backing them. Wealth expanded on paper until panics hit, and people rushed to withdraw gold that no longer existed. Generations lost savings not because they spent their money unwisely, but because the financial system couldn't honor its promises. But the real turning point came in the 20th century. Wars became global. Economies became complex. Governments needed more money than gold supplies could support. So the world's major powers gradually abandoned the old rules. The First World War forced European nations to temporarily suspend the gold standard. The Great Depression pushed the US to restrict gold ownership and adjust its value. And after World War II, world leaders met at Bretton Woods to create a new financial order. They tied global currencies to the US dollar and the US dollar to gold. But the arrangement wasn't sustainable. America spent heavily on rebuilding Europe, funding wars, and expanding its influence. Foreign nations began demanding gold for dollars. The US gold reserves drained. Then came one of the most important and least understood moments in modern financial history. In 1971, President Richard Nixon announced that the dollar would no longer be convertible into gold. Overnight, the last link between money and physical value was gone. From that point forward, money would be whatever governments declared it to be fiat currency, backed not by gold, but by trust, and trust can be stretched, manipulated, quietly eroded. This is where the process of silent theft accelerated. Because once money could be created with nothing but keystrokes, two powerful forces were unleashed: inflation and debt. Inflation was no longer accidental, it became built into the system. Governments could spend more. Without raising taxes, central banks could lower interest rates to stimulate economies. Banks could create credit without limit. And every new dollar entering the system diluted the value of the dollars already in existence. Your grandparents saved money thinking it had fixed value, but the system changed beneath their feet. Over the decades, the purchasing power of money dropped dramatically. A house that cost a few months' salary in the 1950s now costs decades of payments. Education, healthcare, food, everything became more expensive because the currency weakened as more of it was created. But inflation alone wasn't the only force draining wealth. Another force less obvious, but even more powerful, was rising: the global debt machine. Once, countries could no longer rely on gold to discipline spending. Governments began borrowing. A little at first, then more, then much more. Politicians discovered they could satisfy voters today while pushing the cost into the future. Nations went into debt for wars, infrastructure, bailouts, and social programs. Corporations borrowed cheaply to expand. Individuals took loans for homes, cars, education. Every generation inherited the debt of the previous one. But here's the twist: debt doesn't just sit there. It accumulates interest. it demands payment. And as global debt grew from billions to trillions to hundreds of trillions, future generations were locked into a system that quietly transfers wealth upward. How? Because when governments borrow, they pay interest to those who lend, usually banks, financial institutions, and wealthy investors. The taxes of ordinary people go towards servicing national debt, a portion of every paycheck, every purchase. Every economic activity is funneled into a machine designed to reward holders of assets at the expense of those who live on wages. This is why the gap between asset owners and everyone else keeps widening. But the story gets deeper. In the 1980s, a wave of deregulation spread across the world. Banks gained freedom to create more credit, issue complex financial products, and expand risk-taking. The financial sector grew larger than manufacturing, agriculture, and retail combined. Money wasn't just a medium of exchange, it became a product, traded for profit. As credit expanded, the price of everything tied to credit, housing, education, healthcare, climbed faster than wages. People borrowed more just to keep up. The debt machine fed itself. And then came the crises. Every crisis followed the same pattern: easy credit, rising asset prices, sudden collapse. Each time, governments and central banks responded the same way: cut interest rates, print money, bail out institutions too big to fail. But there's a hidden consequence to these rescues. They inflate asset prices even more. People who own stocks, real estate, or businesses gain wealth. People who rely on wages see their purchasing power shrink. This is how money was silently drained from generations before you through policies that rewarded capital while weakening the currency used by everyone else. Let's take a simple example. In the 1970s, one full-time income could support a family. Today, two incomes struggle to afford basic living. But productivity didn't fall. Workers didn't become lazier. What changed was the value of money and the structure of wealth. Your grandparents didn't lose wealth because they made bad decisions. Their money was diluted. Their savings lost value. Their wages fell behind inflation. Their taxes went toward interest payments on debts created by others. And the system kept moving. Now, look at the modern world. The top 1% own more wealth than the bottom half of the planet. Global debt is over $300 trillion, 3 times the size of the world economy. Home ownership is out of reach for millions. Young people feel they're starting life already behind. Savings accounts earn less interest than inflation steals. Work doesn't buy freedom, it buys survival. And central banks, the institutions meant to control inflation, became the most powerful players in the economy. Their decisions on interest rates determine the fate of nations, businesses, and families. A single announcement can wipe out savings, inflate markets, or trigger recessions. But there's a reason this system persists. It benefits those who understand. It rewards those who own appreciating asset stocks, real estate, commodities, things that rise when money loses value. It penalizes those who hold cash or rely on wages. This is how money was quietly taken from generations, not by force, but by policy, not by theft, but by design. Not through conspiracy, but through incentives built into a system that evolved to favor those who had capital from the start. And the pattern keeps repeating when crises hit. Money is created when money is created. Value shifts when value shifts. Assets inflate when assets inflate. The wealthy get richer. When the wealthy get richer, they gain more influence over policies, and policies shape the cycle once again. But the story isn't over. The same mechanisms that took wealth from generations before you are still at work today: currency dilution, rising debt, asset inflation, declining purchasing power, and policies that prioritize financial markets over workers. And unless people understand how the cycle works, it will continue before we end. Let's leave you with 3 takeaways. First, money is not a fixed thing. Its value changes based on policy, trust, and supply. Holding cash isn't the same as holding wealth. Second, debt is not just a number. It's a mechanism that transfers wealth from the many to the few across generations. Third, the financial system rewards those who understand it and punishes those who don't. Knowledge is no longer optional. It's a survival skill. The final question is this: now that you know how the system was built, what will you do with the information? If this opened your eyes, share it with someone who needs to see it. And if you want more deep dives into money, history, and the hidden structures shaping your life, consider subscribing. The more you understand the system, the harder it becomes for the system to control you. Because once you see how money really works, you realize wealth was never stolen in a moment. It was taken slowly, silently, and systematically. But it can also be rebuilt one informed mind at a time.